Hello, everybody. Welcome to Talking About Houses. I'm Todd.
I'm Juana.
Okay, so today we're going to talk about an article that was in Bloomberg. Here is why the housing downturn is nothing like the last one.
Mm-hmm.
Okay? All right. First bullet point, the housing market has cooled off a bit after incredibly hot stretch fueled by the pandemic. That doesn't mean it's about to be 2007 all over again. So let's talk about what happened the last 2 years. Like why are real estate prices up in the last 2 years?
Well, they're up because, number one, people have been sitting in their pajamas working at home and had nothing to spend their money on.
Okay.
And they've discovered that because they didn't go into an office or whatever exterior work environment they had before, they are now working from home. So now they want their homes to also be their work environment, which means more space, different space where maybe they have a more segregated space from the rest of the household so they can have some quiet and some privacy to get their work done. So this has caused people to kind of reevaluate their home environment and maybe choose a different home environment that better suits their current situation.
Okay, so that's a demographic shift.
Right.
You have people who left cities who are moving to suburbs. They're left the little apartment with their roommates to go get a house. Mm-hmm. They maybe, because they don't have to show up at work, they move to some place further away like Las Vegas or wherever, right? And they're purchasing a house because they're going, wow, I should just buy a house because it's cheaper than paying rent.
Right.
And you have people who are leaving being a renter to go buy, and the last 2 years, except for the last few months, historically low interest rates, making it actually, 2 years ago, it was probably one of the most, matter of fact, we did a video on this a few weeks ago, 2 years ago, and in 2021, it was the cheapest, it was the most affordable to buy a house since 1991.
And if you look at interest rates, without exaggeration, I don't know that interest rates have been that low ever.
Right.
I mean, we're talking thousands of years because, 2 point whatever or 1 point whatever interest rate, the money was basically free.
Yeah, it was basically free money. America's housing market's in far better health today thanks in part to new lending regulations that resulted from the meltdown. So let's talk about that really quick.
Right.
What was going on in 2000? Let's just talk in general terms. It's 2005. Let's say you're a cocktail waitress.
Hey.
You have I'm just using that as an example because in Vegas, cocktail waitresses made good money, but you basically stated your income. Meaning, if you looked at your actual income, it wasn't that much.
Right.
You had this tip, you had this extra tip income that you could just claim, right?
So I'm going to call it service industry, but
yes. You're in the service industry. I didn't say other thing in the service industry. But let's say you had not a great credit score, right? Just a medium, normal credit score. We'll call it, you say you had a 620 credit score, right?
Right. So look,
what could you do? What could you have done back then?
Right. So 2005, 6, 7, what people were doing is they were going out and they were purchasing multiple homes. Now these homes they were purchasing them 100% finance. A lot of times they were getting a 25% equity loan on top of that. So that means that they owed 125% of what the home was worth. They had no money in it themselves. It was all financed. So maybe you were purchasing multiple homes, particularly new construction, that what you were hoping to do is by the time the house was finished, it was worth more than when you got it under contract. So then you could go ahead and put it on the market and sell it. So there was a lot of arbitrage going on. There was a lot of house flipping going on. And it was going on done by people who were not necessarily particularly financially savvy or financially well qualified. And the whole thing just basically collapsed in on itself. The other thing that was going on is the builders were overbuilding because you had all these people buying the homes. So there were a lot of things going on that are very different than what's been going on for the last couple of years.
And it didn't happen overnight. It really took about 3 years. Builders started spooling up, hiring like crazy, borrowing money like crazy to build like crazy because all these people were showing up to buy houses and they were speculating, flipping it to other people who would try to flip the house to somebody else, and eventually it ran out. So here's the next bullet point. There aren't as many risky loans or mortgage delinquencies, although high home prices are forcing many people out of the market. Now, home prices have gone up the last 2 years.
Well, they have, but remember, the people who have been buying for the last 2 years, they are a completely different cohort than the types of people that were buying back then. These are people who are well qualified. They've got good jobs. They've got good credit. And best of all, almost everybody has a lot of their own money in the game. And what I mean by that is these loan products are requiring people to come up with at least 10% down. So these people are coming into these homes with cash in the transaction, which means that they are much more likely to continue to make payments, that they have historically low interest rates. So these are people who are paying less in mortgage payment than they would be paying for the same house if they were renting it. So there really are not a lot of similarities. These are people who are very unlikely to walk away from their homes, even if they move, even if they lose their job. That there are other options. Like I said, they do have equity, and then of course their mortgage payment is pretty low, so they can either sell the house and they'll walk away with money, or they can rent the house out and they can actually rent the house for more than what their mortgage payment is. So it's a completely different situation than it was back then.
So total mortgage debt in the United States is now less than 43% of current home values. So it means if you took the whole housing market, 43% that's the debt, 57% is out of the equity. That's the lowest on record. Mortgage debt is the lowest on record. So auto debt, credit card debt, and student loan debt's the highest on record.
Okay, so
mortgage debt's the lowest on record.
Right. So keep that in mind. Well, on the surface, that's fantastic. I love people being debt-free, and that's fantastic. But that is part of the reason why we have inflation, because people have money.
Yep.
Okay. So they're not servicing debt. They have money. So their money is chasing insufficient goods.
Negative equity, which is when a borrower owes more on the loan than the home is worth, is virtually non-existent. Compare that to more than 1 in 4 borrowers who were underwater in 2011. Just 2.5% of borrowers have less than 10% equity in their home. Think about that. That means 97.5% of all people have over 10% equity. We all know that from a video we did, 40% of all people own their home free and clear.
Right.
40%, 4 in 10 people.
So again, that goes to what I just said regarding what's going on with inflation. This is part of the reason why that's going on, because people don't have the debt that they traditionally have.
So you're probably wondering what about those ARMs? Remember those adjustable rate mortgages, right? There are currently 2.5 million adjustable rate mortgages, or ARMs. It's only 8% of outstanding mortgages. That's the lowest volume on record. ARMs can be fixed usually for a term of 5, 7, or 10 years. I did find out that of those ARMs, now remember there used to be like the 1 year and the 3 year ARM where it was really low rate, like teaser rate for 1 or 3 years, but then it went up. That actually 85% of all ARMs are the shortest term, 7-year ARMs. So instead of like a 1 or a 3 or 5 year ARM, it's 7 years. So yes, that your rate it's a low rate. It's fixed for 7 years. So let's say 2 years ago or last year when home prices went up, you went and got that 7-year ARM because you locked in let's say interest rates are 2.75, but because you got ARM, you got 2.25%, not a 30-year fixed. You're good for 7 years. So it's not like next year you're going to have to, I'm going to get foreclosed, because you have a lower payment probably than everybody else.
Right. And 7 years is a long time. Not that I expect interest rates to be below 3% again, but 7 years is a long time. Your financial situation changes, your life situation changes. So over that period of time, maybe you're making more money, or maybe you decide to relocate. Whatever happens. So it's not a bad thing that you got an ARM. And of course, during the 7 years, you can refinance any time and get a fixed rate loan. So there are lots of choices to be made.
In 2007, just before the housing market crash, there were 13.1 million ARMs, representing 36% of all mortgages. That's over a third. Back then, the underwriting of those types of loans were sketchy to say the least, but new regulations following the housing crash has changed the rules. So everybody learned from the housing crash. and they put in these things so that it wouldn't likely happen again. But so tell me, Juana, there are people out there, their decision making is extremely basic, right? Home prices up, must crash, like must fall, but not necessarily the case.
Right.
Because then using that logic, isn't there going to be a crash in college tuition rates? Like college tuition is the highest it's ever been because people are speculating in college tuition, pretty much, right?
Well,
and it's going to crash. Like college tuitions are going to crash.
Well,
Don't go to college. You should wait 2 or 3 years and go to college in a couple of years because the college tuition market will crash and colleges will be much cheaper.
Right. Well, I don't know about that. So just because prices are high does not mean that they're going to crash. Particularly with real estate, as far as that goes, real estate takes a lot more than that to crash it. I mean, let's face it, it took a lot of, let's call it what it was, irresponsible lending the last time around to get the real estate market to crash. We don't have that this time around. There's a lot of support for the real estate market. We've said that before because so many homes are free and clear. So because of all that, plus we've got the institutional buyers, and there's just a lot more going on in the real estate market than there was before. So the likelihood of the real estate market crashing is really very small. What is likely is that the real estate market will have a cool down, it'll plateau, and it'll start to appreciate at a much more traditional level, somewhere around 5% a year. Once we consider inflation, then probably real estate maybe will go up 13% for a while inflation is high, to kind of adjust for that. But I think adjusted for inflation, real estate will go up about 5% a year.
One of the things that happened back in 2020 was a lot of people stopped making their mortgage payment. Now, normally we have about 2 million homes in the U.S. in pre-foreclosure, meaning they're not in foreclosure. They're behind on payments. Okay, and it went up to 4.6 million, and people got all excited about that. Well, those people went to the banks and they negotiated some kind of deal so they wouldn't get foreclosed, right? But what happened? So a couple of things happened. Home prices went up, and they could basically, even though they were behind their payments, they could sell the house and get out of it and make it up, right?
Right. Most of them didn't, because what happened was the government said all they have to do is mention the word COVID, and the banks had to work it out. So most of the time what happened was they either put them on a payment plan that they could afford for some period of time until they got caught up, or they actually put the missed payments on the back end of the loan. But they made some sort of an arrangement with the borrower that was mutually acceptable between the borrower and the lender, and everybody kind of moved forward. And we know that that's what took place because those numbers that Todd mentioned, as far as the pre-foreclosures and the default numbers, plummeted. And we know that the people didn't sell their homes because we haven't had inventory. So those things are pretty obvious. What's going to happen in the end with those people, we don't know. But for the most part, our take on it is that most people are back on track, or pretty close to back on track, and we're not seeing the tsunami of foreclosures that the market crashers are touting is just on the horizon. We have been doing this for a long time. We have been hearing about the tsunami of foreclosures
since 2010.
For a very long time. And we don't see that on the horizon. We don't see any market indicators that would indicate that. At least not right now, unless some other black swan event happens that changes things. If things keep going the way they have, that's unlikely to happen. People have low interest rates on their mortgages. They will keep making those mortgage payments, or they will rent out the house, and then the tenants make the mortgage payment through their rent. They can sell the house and put the equity in their pocket. So property owners have a lot of choices, and the choices that they have all, for the most part, have a positive outcome for the borrower.
The mortgage market is on very historically strong footing, said Andy Waldman, Vice President of Enterprise Research at Black Knight. They're a big mortgage company. Even the millions of homeowners who availed themselves of forbearance during the pandemic have by and large been performing well since leaving their plans. So the bottom line is everyone has so much equity and everyone has low payment. They're doing everything they can to stay in the house, even if they haven't been working. But that was a very short thing because actually unemployment right now is at like the record lows. Like everybody that is working. We actually have the opposite problem. We have a labor shortage, meaning we have people who've left the workforce and said, I'm done. They call it the great resignation. I'm done. I'm not working anymore. And we actually need we need that labor because everyone can go get a job.
Right. So, with the rise in interest rates, with the recession on the horizon, that may change. Unemployment may go up a little bit, but it probably won't go up substantially. And of course, if you're unemployed, then that's bad for you. And we understand this.
Come to stressful. Vegas. We have tons of jobs.
We understand that that's a stressful time in your life. But, as far as statistically speaking, unemployment is going to remain relatively low and manageable. As far as inflation is concerned, the Fed is working very hard to get that under control. It takes time. We didn't get here overnight. We're not going to get there overnight either. It takes a lot less time to get to where we are because, of course, of all the money that has been put in circulation over the last couple years and everything else that has happened. So it'll take a while for that to kind of work its way through. But, probably within about a year or so, that'll all kind of work its way through and start to get a whole lot better. As far as real estate prices and what that means for real estate as far as inflation's concerned, real estate tends to weather inflation pretty well. So chances are that your home or your rental property will continue to go up in value. And you've got that fixed mortgage in there that you're servicing the debt at a fixed rate, especially against inflation. You're collecting rent at a higher rate and paying that debt, or if you're living in the house, again, you're not having your rent go up. Your mortgage payment is probably fixed, and so that part of your budget is something that you can count on.
That's something interesting that people don't talk about, or they do talk about maybe, but the housing crashers that aren't talking about it apparently. Let's say that it's a couple hundred, let's say you go buy a house and it's $200 more a month to buy it than rent where you live. And you go, well, it's more and you saw a video that someone in your market did. It's more affordable to rent than buy in fill in the blank, right? Miami or some other place, right? But then you realize, well, wait a minute. But if I'm a renter, my rent can go up every year. But if I get a 30-year mortgage, it's $200 a month more. But how long will it take before the rents exceed that number?
Right.
So maybe you buy the house and then in 2 or 3 years, your mortgage has stayed the same, but rents have appreciated. Right. Rents have gone above it. And now every year rents go up and up and up. In some markets, like in Las Vegas, median rent 4 or 5 years ago was still $1,400, and now it's like $2,200. So it's gone up 50%. And if you said, "Oh, I don't want to buy that house because the mortgage is $1,500, but I can get a rent for $1,400," and now you are paying $2,200. You're paying that. Right.
Well, and then of course, remember the government subsidizing mortgage payments through having the interest write-off and the property tax write-off and all kinds of things like that. So there are reasons to be a homeowner versus a renter. We understand that not everybody can be a homeowner, but it's just something for you to keep in mind as you're laying out your financial map going forward.
Yeah, we thought this was interesting because other than home prices going up, there's literally zero things in common with that last when the housing market crashed. It's certainly been cooling off because of interest rates mainly. But then again, inflation is pushing everything to be, and people with cash are sitting there going, what am I going to do with this cash? It's being deflated away. Right. I should go put it in some asset that'll appreciate. And they've been buying at record numbers, the highest in history.
Right.
They've been buying real estate.
Right. So that's part of the reason why real estate's been so hot is inflation. people trying to put their money somewhere that the value of their money will at least not depreciate through inflation, because inflation is not something that the rest of us can control, but inflation is something that we can manage by how we use our money.
I want to talk about one last thing. This is something, okay, so this is so all of the stuff, first of all, I haven't heard any of the housing crashers talk about any empirical data. It's all hyperbole, okay? Okay. What they say is, well, but the recession, this is what's going to happen in the recession. People are going to lose their jobs. Well, first of all, people work, because like 50,000 people lost their jobs, that's not the whole U.S., right? So some people, as industries change, people lose their jobs, but they'll get other jobs, right? Okay. And then they'll have to decide between feeding their family and making their mortgage payment, right? That's actually not true. What they'll have to decide is, do they want to give up their $1,500 a month mortgage payment and get rid of the house and go pay $2,200 a month? Or do they just want to get rid of their Netflix subscription? Like, there's all these other things they're going to get rid of first before they get rid of that 2.75% interest rate. Like, they're not going to give that up for life. Like, they would probably just stop eating out. Like, the people that will get hurt in the recession will be maybe the retail industry. People will buy less stuff. People might buy less cars, potentially. They probably will... they'll cancel some of maybe their gym membership or other things that are on a monthly basis, right? Netflix. We saw what the record number of people canceled Netflix, but they're not giving up that smoking rate they got. Like, they will, if that's all the money they have, they would just pay that and pay nothing else probably.
Right.
Or they would rent out a room to somebody, but they're not going to like stop paying their mortgage and get foreclosed and then remember they have a ton of equity. They're not giving that up. Like, people are this isn't like last time where they literally had to, because they owned a house they were upside down in, they had a ridiculous payment, and they had no tenant in it. That was what crashed the housing market. Neither one of those three things exists right now.
Right. So, look, if somebody loses their job, they're much more likely to find a way to make that mortgage payment, because that mortgage payment is probably less than their rent payment would be, even for a lesser house. So everybody's got to live somewhere, and so they'll make it happen, whether that's borrowing money or whatever it's going to take for them to keep a roof over their heads. And chances are that people are going to keep those homes for as long as they can, because they are more affordable than renting. Now, to Todd's point, if that's just not possible in any way, shape, or form, then they'll go ahead and they'll sell the house. But that house still has equity in it, and it's not going to get foreclosed. It would not make sense for somebody to let the house be foreclosed and forego their equity.
If you like the video, please subscribe, hit the notification bell, leave us a comment, and we'll see you on the next video.
Bye.
Bye.